Most traders think that the market is moving because of technical patterns, but the real reason markets are shifting right now has nothing to do with charts. It starts with oil, the Strait of Hormuz, and geopolitical conflict that could keep energy prices elevated for months. And when oil rises, inflation rises. When inflation rises, bond markets react. And when bond markets react, everything else in the financial system starts to move. Stocks, currencies, gold, even your trades. So in this video, I'm going to break down exactly what's happening in the macro environment right now, where the dollar is starting to strengthen, why bond yields are rising, and where the markets may be starting to price something traders haven't had to deal with for years: stagflation. Let's start with oil, because oil is where this entire macro chain reaction begins. The Strait of Hormuz is one of the most important shipping routes in the world. Roughly 20% of global oil supply flows through this narrow passage between Oman and Iran. So when global tension rises in the region, energy markets react almost immediately. Recently, tensions involving Iran have increased, and there are serious concerns about disruptions to oil shipments through the strait. Because of this, oil prices have surged towards $100 per barrel, and Iran has suggested that the Strait of Hormuz could remain closed for an extended period of time. That means markets are beginning to price a scenario where energy supply remains tight for longer than expected. But oil doesn't just matter for energy traders, oil matters for inflation. When inflation prices rise, transportation costs increase, manufacturing costs increase, shipping becomes more expensive, and fuel costs rise for consumers. Those costs ripple down through the economy, and eventually they show up in inflation data like CPI. Now, the latest US CPI reading came roughly in line with the expectation, around 2.4%. At first glance, that looks stable, but the markets don't trade the past, they trade the future. If oil continues rising, inflation could start moving higher again in the months ahead, and that creates a problem for the Fed. Because for most of the past year, markets were expecting the Fed to cut rates aggressively. The narrative was simple: inflation was cooling, growth was slowing, and the central bank will soon begin easing policy. But rising oil prices are now challenging that narrative. If inflation starts rising again, the Fed may not be able to cut rates as quickly as the market expected. And that brings us to one of the most important markets in the world: the bond market. The bond market is essentially where government borrow money. When investors buy US Treasury bonds, they are lending money to the US government in exchange for interest payment. But the key thing traders need to understand is the relationship between bond prices and bond yields. When investors sell bonds, bond prices fall, and when bond prices fall, yields move higher. So when you hear bond yields are rising, what that means is that the investors are selling bonds. And one of the main reasons investors sell bonds is inflation risk. If investors believe inflation will stay high, they demand a higher interest rate to compensate for that risk. And that is exactly what we are seeing right now. As oil prices rise, investors begin worrying that inflation could remain elevated. And as those expectations change, bond yields start moving higher. This also means something else is happening behind the scenes. Markets are beginning to unprice aggressive rate cuts. For months, traders expected that the Fed Reserve will cut rates quickly, but now those expectations are changing. Instead of lower rates coming soon, markets are beginning to price higher rates for longer. And when that happens, it pushes bond yields higher and strengthens the US dollar. This combination of rising oil prices and rising bond yields is starting to create fears for something called stagflation. Stagflation is one of the most difficult environments for markets. It happens when you have high inflation, slow economic growth, and rising costs across the economy. Normally, when growth slows, central banks can start cutting interest rates to stimulate the economy. But in a stagflation environment, they can't do that easily because cutting rates increases risk of making inflation even worse. So policymakers become trapped between two problems. If they keep rates high, growth slows. If they cut rates, inflation rises. And that creates a very difficult environment for the financial markets. We are already seeing signs of pressure in the equity markets. The Dow Jones recently dropped sharply as oil prices surged and geopolitical tension increased. High energy prices act almost as a tax in the global economy. Companies have higher operating costs, consumers spend more money on fuel, and the economic growth begins to weaken. So, when oil rises rapidly, equity markets often start pricing in a slower growth ahead. At the same time, the US dollar is starting to strengthen. There are two main reasons for this. First, rising bond yields make US assets more attractive to global investors. Second, during periods of geopolitical uncertainty, investors often move money into safe haven currencies. And the US dollar sits at the center of the global financial system. So when yields rise and risk increases, the dollar often strengthens. Recently, we've seen signs that the US dollar index may be beginning to break out, and that has major implications across markets. A stronger dollar puts pressure on commodities, tightens global financial conditions, and can weaken currencies like the euro and pound. This is why I'm watching the GBPUSD very closely right now, because a stronger dollar environment can create downside pressure for that pair. Now, let's talk about metals, especially gold. Normally, gold benefits from geopolitical uncertainty. When global risks rise, investors often buy gold as a safe haven. But right now, gold is facing two competing forces. On one side, geopolitical tensions, inflation concern, and safe haven demand. But on the other side, rising bond yields and a stronger dollar, both of those forces tend to weigh down on gold prices. So gold is currently stuck in a tug of war between inflation and rising yields. If we step back and look at the broader macro environment, this is what we are seeing. Oil prices are rising, bond yields are rising, markets are repricing rate cuts, the US dollar is strengthening, and the equity markets are beginning to feel the pressure. This combination creates a much more macro driven trading environment, and traders who understand this relationship have a major advantage. That is exactly why tools like Star Edge become important. Because markets don't move based on technical patterns, they move because of fundamental, sentiment, and positioning. Tracking all this manually is extremely difficult. You need to monitor economic releases, bond markets movement, currency strength, institutional positioning, and sentiment indicators. That's why I built Star Edge. Star Edge combines macroeconomic strength, sentiment data, and market trends to give you a clear view of which assets are strong and which are weak. Instead of guessing where the markets are moving, you can see the underlying forces driving the price. Right now, the macro story is evolving quickly. Oil prices are rising because of geopolitical tensions. Bond markets are beginning to unprice aggressive rate cuts. The US dollar is strengthening as yields move higher, and the equity markets are becoming more sensitive to inflation risk. All of these forces together point to a market environment that is becoming more volatile and more macro driven. And traders who understand these forces will always have an advantage. If you want to try Star Edge, click the link in the description below or head to vegatrading.page. You can try it for free. And if you enjoy this breakdown, Make sure to like, subscribe, and follow for daily market analysis.